The Fed will coerce the Great Depression 2.0 after creating the Great Inflation 2.0. Are you kidding? Even the Federal Reserve is losing money? How could this happen? This just happened. They are literally spending more money than they are making. Check out this chart. They are losing billions of dollars as of this September. We just got info that the Fed is upside down. That's right, the Federal Reserve with thousands of experts and PhDs can't even balance the income and expenses anymore. Are they trying to be like early days with Amazon and Tesla? They were like, oh, we are losing money because we need to grow as fast as we can so we can take all the market shares. Well, the Federal Reserve, the most powerful central bank in the world, is now officially behaving like a growth stock, losing billions of dollars. It's almost like the people with the most power in the world can literally go to our banks, hike our interest rates, hike rates on our cars, our homes, and our credit cards, tank our investment portfolios, and at the same time, they can make sure they get out at the top, right before the stock market crashed. Oh, because that's exactly what they did. They quantitatively eased the market to the maximum capacity in conjunction with fiscal stimulus checks, created the Great Inflation 2.0. At the end of 2021, the board members of the Fed sold their stock portfolios because they wanted to avoid any conflicts of interest. Right. And then they proceeded to crash the markets. So what is happening? And how does this work? Why all of a sudden is the Fed losing money? Are we heading into the Depression 2.0 for sure now? That the Fed can't even bail themselves out, let alone the market? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these markets, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a sweet boy, go to patreon.com/magicalgoddesscheryl to support all my work. If you want to be my good boy, apply to write your first book with me, author of best-selling books, Goddess Cheryl. My good boys always obey, and they always get rewarded handsomely. Have you been a good boy? You will get the encouragement you need on your author journey. This is a chart of reverse repo facility, and ever since March 31st of 2021. There are some rule changes at the Fed with banks regarding their reserves, due to the largest amount of stimulus checks sent by the US government to everyone's bank account, and essentially the usage of this reverse repo facility has exploded. It's basically an opportunity for banks to take excess cash that they have, so extra savings that we have deposited with banks and that they have sitting around as cash. They are able to put them into the Fed's balance sheet overnight. And it goes back and forth every day. Except when they get the money back, they get a little bit of interest. The Fed currently pays interest not only on this repo facility, but also the other overnight reserves. And in total, there are about $5.2 trillion in reserves the Fed has to pay interest on. Well, that interest rate used to be 0 to 0.25%. So basically cost the Fed nothing. The total payment now, though, has changed. Now they are paying about $469 million per day. That will become $570 million when they raise the rate to 4% in November. They will have to pay that every day to the commercial banks parking their cash. Now, these reserve balances are a lot, but the Fed also makes money. Most of the money they make is from the system open market account. It's basically just where they park their treasury bonds and mortgage-backed securities, and those pay interest. Back in QE days, they make a lot of money from those treasury bonds and securities just by printing money digitally on their spreadsheet and buying treasury securities from U.S. Treasury Department and institutions like the commercial banks. So both the government and the commercial banks get their cash the Fed created. They say those cash or reserves only are supposed to stay within the banking system. But we all saw the banks use that money to buy stocks and bonds. And government used part of that cash sent out as stimulus checks to people. When a company's stock goes up, it pays more wages to their employees. Plus, there were labor shortages in 2021. Employees ended up with way higher wages. When people have more money, they spend more in the economy. So there are more demand than supply in energy because people were spending, consuming every day. In an auction house, when more people want the same thing, prices were bid up. This is how the Fed created the Great Inflation 2.0. Now it's all upside down. U.S. Treasury asks major banks if it should buy back U.S. government bonds. The U.S. Treasury Department is asking primary dealers of U.S. Treasuries whether the government should buy back U.S. government bonds in order to improve liquidity in the $24 trillion market. Investors are worried about reduced liquidity in treasuries as yields rise, and volatility increases in line with rapid rate increases by the Federal Reserve, which is struggling to bring down inflation that is running at its highest levels in 4 decades. Deflation will become the problem when something breaks. While the Fed continues to hike rates to combat high inflation levels aggressively, history shows that deflation will become a more significant threat when something breaks in the financial or credit markets. Stable markets can become unstable rapidly when something breaks due to the rising rates or volatility. The Bank of England, BOE, is a current example of what happens when things go awry. The BOE on Wednesday was forced to start buying bonds to solve a potential crisis with UK pension funds. The pension funds receive margin when yields fall and post additional collateral when yields rise. As they have recently, the pension funds are hit with margin calls, which have the potential to cause market instability. Due to leverage built up through the financial system, market instability can spread like a virus through global markets. That's what happened in 2008 with the Lehman crisis. In the US, given the sheer magnitude of leverage throughout the financial system, we are likely well on the cusp of an even bigger break as the Fed officials double down on the need to aggressively raise rates to fight what appears to be falling inflation, regardless of the systematic consequences. Those systematic consequences of the Fed tightening monetary policy have repeatedly occurred throughout history. The Latin American crisis resulted from rising rates impacting dollar-denominated debt. That crisis could have rendered many U.S. banks insolvent. Rising rates triggered the 1987 market crash as portfolio insurance failed. Following that was a series of adverse events from the 1994 bond market crash. the Mexican peso crisis, Orange country bankruptcy, Asian contagion, Russian debt default, long-term capital management, the dot-com crash, and the financial crisis. While high inflation rates are certainly problematic for the economy as it creates demand destruction, the more considerable risk remains financial instability, which is deflationary. As we will discuss, deflation remains a more significant threat for the Fed as it coincides with wealth destruction, further undermining consumer confidence. Inflation is unsustainable. Inflationary pressures can be a good thing when they correspond with strong economic growth and productivity. However, when price inflation rises faster than wages and increases debt servicing costs on heavily levered households, the resulting liquidity contraction triggers economic recessions. In our view, such tightness is unsustainable because it will lead to intolerable economic and financial stress. The chart below shows the three major components that comprise inflation. Number one, commodity prices that reflect real economic activity. Number two, wages that allow for increases in spending and support for higher prices. And number three, the velocity of money shows the demand for money through the economic system. When we combine these three components into a composite inflation index, we can see that high inflation rates precede recessions and deflationary periods. There is an inherent problem with the chart above. The inflationary spike was not a function of organic economic activity, but rather artificial capital injections into a supply-stricken economy. The surge in demand against limited supply created a surge in prices along with commodities. However, organic economic demand remained weak as the monetary base failed to gain traction. While many today compare the economic environment to the 1970s inflationary spike, the impact of demographics and debt are vastly different. As discussed in Sugar Rush, as the liquidity injections dissipate, the deflationary pressures are again reasserting themselves. The problem for the Fed is additional rate hikes will exacerbate the deflationary processes already at work in the economy. As such, when the eventual recession occurs, demand destruction will likely be more significant than anticipated. A brief review of previous inflationary periods suggests such will be the case. A brief history of deflation from inflation. While many believe periods of high inflation are persistent, history doesn't support such claims. Such is because high inflationary periods also correspond with higher interest rates. In highly indebted economies, as in the US today, such creates faster demand destruction as prices and debt servicing costs rise, thereby consuming more of available disposable income. The chart below shows real interest rates, which include inflation going back to 1795. Not surprisingly, each period of high inflation is followed by very low or negative inflationary deflation periods. As noted initially, surging interest rates impact market functions, leading to financial instability. Thin U.S. Treasury liquidity and limited demand may make the U.S. market vulnerable to a market functioning breakdown, similar to UK. As the Fed continues to hike rates to fight an inflationary boogeyman, the more considerable threat remains deflation from an economic or credit crisis caused by over-tightening monetary policy. History is clear that the Fed's current actions are once again behind the curve. While the Fed wants to slow the economy, not have it come crashing down, the real risk is something breaks. Each rate hike puts the Fed closer to the unwanted event horizon. when the lag effect of monetary policy collides with accelerating economic weakness, the Fed's inflationary problem will transform into a destructive deflationary recession. Yes, the Great Depression 2.0 is coming. So now I'm going to show you my client David Vine and Jema's book, Ignite the Passion, Co-Create Your Dream. This one is such an incredible book. And my client Taddy Eazzy's Wicked Pussy Perfume. This one is an erotic novel, so amazing. And my book called Abundance. It is a bestseller, this one. Another awesome book. And my Jingle Bell Magic, Ask and It Is Given. It is a bestseller, this one. Another one of my books. So I hope you've enjoyed all the content today. Please order your copy of a book. It does help with depression, anxiety, and stress. We are living in uncertain times. I thank you for being a fan and supporting me. Please like my video. Bye.